Let's talk about overperforming the stock market, or in other words, doing better than the S&P 500, which is like, the baseline after which everyone is trying to get to and trying to compare their investing performance against. You see, lately, in the last few years, this idea has started to brew that you cannot beat the market, and therefore, there's no point in even trying to analyze individual stocks because you might as well join the market if you can't beat it. I'm sure that if you are interested in investing at all, I bet you've seen these articles that say something like 99% of active fund managers cannot beat the market. Something like that. There's a lot of these articles out there, and they kind of get this idea in your head that it's impossible to beat the market, or you have to be an incredibly talented fund manager just to be able to get better returns than the market. Well, in this video, I'm going to show you why that's actually wrong, why I've beaten the market myself. But not only that, I'm also going to show you 5 very boring dividend stocks that not only have outperformed the market, but they've crushed the market over the last 20 years. And hey, make sure to stay till the end of the video because I'm going to show you the very simple technique that I follow to make sure or to be very likely that I'm going to beat the market. That'll be at the end of the video. But with all that said, let's begin. Hello, welcome to the Escape into Freedom YouTube channel. We talk about dividend investing and personal finance on this channel. So if you are new, make sure to subscribe, just click that button below. Make sure to like this video because it really helps to show my videos to more people, okay? So before I show you those 5 very boring dividend stocks that have outperformed the market, I want to give you a little disclaimer. I'm not a professional, money advisor, okay? Don't take my advice, really just do your own research. I think that I'm giving you the best information that I can, but then again, don't just buy stocks just because you've seen them on my channel, okay? Also, passive investing, which means investing in index funds that have very low fees, I think it's a wonderful way for a lot of people to get started investing, or even perhaps invest like that for their entire lives, okay? It really is very good. If you get as good a performance as the overall stock market or as the S&P 500 or whichever country you want to invest in, that's already going to be really good, okay? So don't discount it just because I'm telling you can do better than that. Having said all that, you definitely can get better returns than the market. Warren Buffett's done it. Peter Lynch has done it. Those guys got 20-30% annualized returns. Personally, I've got better returns than the stock market. Not, by no means like Warren Buffett or Peter Lynch, but something substantially better than the stock market. And over many decades, just an extra 2 or 3% per year can mean a world of money, okay? You can do a lot better than the market with, instead of, let's say, an 8 or 9%, if you're able to get a 10, 11, maybe 12% annualized returns, which I'm not saying it's easy, but if you can get that, that's really gonna dramatically impact how much money you can actually earn with dividends and how much money you're left with at the end of your career when you actually need that money, okay? So with all of that said, guys, I'm just gonna go to my room. I'm gonna show you my computer and I'm gonna show you 5 very boring dividend stocks that have crushed the S&P 500. So yeah, guys, here we are. I'm just gonna jump into my computer in a second. But first, just admire my little bonsai tree. I've just, you can't really see it very well. I've bought it to kind of add a little bit more green to my scenery and to actually, I don't know, breathe a little bit more oxygen, perhaps. But anyway, let me show you what these 5 dividend stocks are. I don't want this video to be super long, okay? So I'm gonna show you what these stocks actually do to make money, what the company actually does. You'll see how boring they are. And then I'm gonna show you basically their performance over time, okay? So let's jump right in. The first company that I wanna talk about is called Hormel Foods. Now, if you live in America, I'm sure you know of Hormel Foods. They make basically meat stuff and packaged foods, right? Really, really boring stuff that people are always going to need, basically. People are always going to need this kinds of food and, really convenient food. Despite how health conscious people get, I really believe that people just sometimes crave like packaged foods, okay? And Hormel are one of the best in this area. Now, I'm not going to get into the fundamentals too much. I just want you to notice that they've been increasing the dividend non-stop since 1967, which is 54 years, which is absolutely mind-blowing. But let's just scroll down all the way to this new addition into Dividend Compass. By the way, there's a link to Dividend Compass in the description of this video. If you want to look at this data, get access to this data, just click on Dividend Compass and you'll be able to access all of this yourself. But yeah, let's keep scrolling, and there's this new area called performance. Now in purple, you get the S&P 500 or SPY, because that's how most people actually buy into the S&P 500. They buy the fund SPY, the ticker symbol is SPY. So basically, this is what I'm using to compare it against. Now you can see that in this scenario, you invested $10,000 back in 2001, right? 20 years ago, both in Hormel Foods as well as SPY. And you can see that actually, for 99.2% of that time, Hormel Foods would have given you more money. And not just a little bit, but a lot more money. So, $10,000 would have converted into $53,000. That is including dividends, not reinvested dividends, but adding up all those dividends that you would have earned when you invested in the S&P 500. So don't get me wrong, your money would have multiplied by more than 5 times, but, compared to Hormel Foods, where those same $10,000 would now be $151,000, and you would have received almost $19,000 in dividends over that time. So yeah, really boring company, but actually does a lot better than the market. So that was the first example of a very boring company that has outperformed the market. The second company is Lowe's Companies. I love this company. I actually made a video about this company. I'm gonna put it somewhere around here. Okay, just click on that. There's like a 20-minute video where I go really detailed into Lowe's Companies, because I personally think it's one of the best companies that pays a dividend and grows it in the market right now. It's not very cheap at the moment that I'm recording this. As you can see over here, it's almost 60% overvalued. Okay, so it's very expensive. But let me show you the performance of Lowe's Companies. Their dividend track record is incredible, but their price performance, again, it's even better than Hormel Foods. Okay, those same $10,000 invested 20 years ago would now be worth $178,000, and over that time you would have received $13,000 in dividends. So again, boring company that's probably always going to be needed, that has outperformed the stock market. All right, the third company is called Air Products and Chemicals. This couldn't sound more boring if you tried. Okay, I mean, if you're a beginner investor perhaps, and you really want to buy into, Tesla or really exciting things, electric cars, okay, this is probably not a company that you would invest in. However, it's one of the best companies, again, in the market, in my opinion. I personally own this company. In fact, I own, I think, 4 out of the 5 companies that I'm going to show you. I own them in my own portfolio. And yeah, Air Products and Chemicals is actually a basic materials company, okay? That's the sector that it operates in. I've actually tried to choose companies from different sectors just so that you can see, that you are well diversified. Should you want to invest in these companies, they are from different sectors, okay? Hormel was consumer defensive, Lowe's was consumer cyclical, and Air Products and Chemicals is a materials company, okay? And the industry within that sector is chemicals, all right? They make chemicals of all sorts, okay? So let's have a quick read. The company produces gases, oxygen, nitrogen, argon, okay? Like I said, really, really boring stuff. But once again, if we scroll down to the performance area, this is where you'll see that, again, it's outperformed the market. It's not done as well as the other two, but still 100% of the time, assuming that you bought at 20 years ago, it has actually outperformed the S&P 500. So again, another example of how you can beat the market. Okay, now let's talk about 2 companies that actually are not inside the S&P 500, because the last 3 companies are actually parts of the S&P 500. So when you invest in the index, a little chunk of those companies is actually technically yours. But the next 2 companies that I'm going to show you are not in the S&P 500. They are actually too small to be included in the S&P 500. And if you invested only in index funds or ETFs, perhaps you never actually have exposure to these 2 companies. And they are really good companies. So it would be a real shame if you didn't own these companies. So one of those is called Bank OZK. Again, one of my favorite companies. I do own this company in my portfolio. It's got a really good track record of dividend increases. And here you can actually see it's a mid-cap company with a market cap of only 5 billion. You know, great dividend growth, really phenomenal dividend growth rates over the last few years. Anyway, I'm getting into the fundamentals. It's really difficult not to start using Dividend Compass because of how easy it is to get data. But let me scroll down and let's go to the performance area. And actually, this one's insane. This one has completely crushed the S&P 500, okay? $10,000 invested 20 years ago would now be almost $800,000 invested in Bank OZK, and you would have actually owned $117,000 just in dividends, right? So just the dividends that you would have received with Bank OZK would be more than your entire money invested in SPY, okay? That's how crazy you know, some of these companies can get. Okay, the fifth and last company that I wanted to show you is called Carlisle Companies. This is an industrial company and they mostly make stuff to do with building products and equipment. Again, this is a really high quality dividend growth company, 44 years of dividend increases. This is the only company that I don't personally own. I've just still not been able to find it at an attractive valuation. As you can see, it's currently 27% overvalued. And again, the performance has been pretty good, actually very good. So there was a period here where it looks like the S&P 500 did slightly better. I can't exactly find it. Yeah, I think it was there. There was a very brief blip where the S&P 500 did better than Carlisle, but for 99% of the time, you know, Carlisle has actually beaten the market. Okay, so I really hope you've enjoyed this video, and I really hope that, you know, you've been able to see that it's not all black and white, okay? It's not like if you invest in the index, you'll do really well, and if you pick stocks, you'll do really badly, okay? It really depends on one thing. The one thing that you can do as an investor to not guarantee, but kind of ensure that you're at least getting a good deal and that you'll be very likely to actually beat the market in the long run. And that one thing is valuation. In other words, how cheap or expensive the stock is, okay? This is so important, okay? Valuation really does matter. And I kind of feel like in the YouTube community, valuation is not always talked about that much. People will just buy a stock that's exciting at whatever price, okay? And a great example of this is Tesla, okay? I really don't think anybody should be buying Tesla at the moment. You can make whatever arguments you want, but it's simply not at an attractive valuation. Now, I'm not going to talk about the different valuation methods that are out there. There's quite a few. They're actually not that complicated to get right. And again, if you create an account with Dividend Compass, they're all done for you, okay? You just get a number and it says, you know, the valuation grade, okay? It really makes your life very simple. So the basic premise here is that you're gonna buy a stock at either its fair value or slightly under. What that means is that if you've bought a stock that's slightly undervalued, even if the stock does badly over time, you're still way less likely to lose money over time. Whereas if you buy when it's really expensive and, you know, everything seems perfect in the world, then if that stock does badly, it might actually take you a long time to recover your money. So basically, you're minimizing risk and also you're maximizing the possibility that you're going to outperform the market. So I really hope you've enjoyed this video. I really hope you've enjoyed those 5 companies that I've shown you. And also, you know, really take into consideration valuation next time you consider, you know, investing in a stock, okay? Make sure you give this video a like if you've enjoyed it. Let me know in the comments below what you think of valuation, whether you just invest in index funds or you like to, you know, choose stocks, pick stocks, dividend stocks perhaps, that might perhaps beat the market. Anyway, that's been my video for today, guys. I'll see you in the next one. Bye-bye.